Greetings everyone, I'm Ingram from AllQuant, and today I'm going to introduce to you another asset class, bonds. While some of you may not be that familiar with bonds itself, the bond market is actually larger than the stock market and also very actively traded. So today we'll be covering again a very few basic questions here. First, what are bonds? Second, what are the different types of bonds out there? Third, why invest in bonds? Okay. Fourth, what are the risks involved when you invest into bonds? And finally, how do you invest in bonds itself? Alright, so let's begin. First question, what are bonds? Now, bond is essentially just a form of debt. So imagine the scenario here. So we have a private loan arrangement between the lender and the borrower, right? And in this case, right, the lender lends the borrower $1 million. And in return, the borrower agrees to pay him 3% interest, right, a year over 10 years. And after which he will then repay him back the $1 million in full. Alright, now this arrangement is a one-to-one arrangement. But if you want to borrow a larger amount of money, right, it would be good if you can break it up into smaller parts and then extend it to more people, like the public or the institutions. Because if you do it that way, basically anyone can lend you the money and it will be easier, right, for you to raise the amount of funds that you need, right, to do whatever you need to do, right? So a bond is just that. So a bond is a debt or loan the lender offers to the wider public. Alright? And on top of that, unlike private loans such as a bank loan, bonds, right, on the other hand, can be traded in the secondary market through a broker after it is being issued. So that means the current holder of the bond can sell his bonds to someone else who is interested in buying. And of course, the bond price will also be fluctuating based on market conditions then. Okay, so this is very much like buying and selling the shares of a company. Now, a bond is typically defined by a few terms, and the first is what we call the face value or the par value. So this is what you will get back when the bond matures, and in this example, you'll be getting back $1,000. Okay, the second is what we call the bond maturity, which tells you the duration of the bond, and in this case here, the bond will mature in 10 years. Next is the coupon rate. So this is effectively the interest the bond issuer will pay you for holding on to the bond issuer. So it is calculated based on the face value. And for this particular bond here, you'll be getting $50 a year, right? Because it's 5% of that $1,000 in the face value. But do take note here, not all bonds pay coupons though, okay? And some of the bonds are what we call zero coupon bonds because they don't issue any coupons. And for those bonds, right, what happens is that they are usually issued at a discount from the face value. So the difference between the face value, which is what you will get when the bond matures, and the discounted price that you pay, right, that will be the interest payment for such bonds here. Then finally, there is the coupon frequency. So this is how the coupons are distributed over a year, or how the coupon payments are distributed over a year. And in this case, the frequency here is semi-annual. So this means that it will distribute the coupon payments in 2 payments over a year. So you'll be getting 2.5% after 6 months and another 2.5% after 12 months itself. Next question, what are the different types of bonds out there? Now, bonds can be largely segregated into 2 types. The first is bonds issued by the governments and its agencies, and the second type is those that are issued by corporate companies. All right, and why would they want to do that? They do that because they want to raise funds in order to finance their projects and operations. And as for the case for corporate bonds or companies issued by companies, so they can actually also do it by issuing shares of the stocks in order to raise money. But usually companies refrain from issuing shares because that dilutes the shareholder interest, right? And also dilutes their level of control. And the cost of financing using equity, right, or stocks is generally also higher. Okay, so most will opt for debt financing instead. All right, a bit more about government bonds. So government bonds include those that are issued by the Treasury. So they are the Treasury bills, which are basically short-term loans that last from like a month to 12 months. Then there is also the intermediate-term Treasury notes, which last for like 10 years, right? And then there are the longer-term, right, Treasury bonds, which has duration going up to like 15 years or even longer than that. Okay. Then there is also what we call the Treasury Inflation Protected Bonds, or in short TIPS. So basically these bonds have a special mechanism where it allows them to adjust their coupon payments according to the level of inflation. So if inflation gets higher, the coupon payouts also gets larger for these bonds itself. Okay, then there are also bonds that are issued by government agencies like your Freddie Mac and Freddie Mae, as well as the different city-states and municipalities. Okay, so these bonds here, right, are all backed by the US government, so they are considered to have virtually no default risk. Now moving into corporate bonds. Now corporate bonds can be largely segmented into two different groups, right? The first is the investment grade bonds, and the second is what we call the high yield bonds. So high yield bonds also have another name, while they're also called junk bonds, right? So investment grade bonds are bonds issued by companies with good credit rating. So these are usually your large and established companies. So the probability of these companies defaulting is very, very low. Okay, high yields, on the other hand, is on the other end of the spectrum. So these are basically bonds issued by companies with poor credit ratings. Okay, and of course their default rate is significantly higher, right, than investment grade bonds itself. But so if I were to range, right, risk levels of the different groups of bonds as well as the yields or the returns that you can get from them, right, it's going to look something like this. So your safest bet will be the government debts. They're virtually free of default risk, right? Because these debts are backed by the US government. And if they ever owe you money, they can always print more money to pay you back, right? So, but the yields among this group will also be the lowest. Okay, then next in line is your investment grade bonds, right? Ultimately, right, these bonds are still issued by businesses. So even though they're good quality companies and the default risk is low, there is still some default risk. Okay, but in return, right, while bearing the default risk, their yields are usually higher than government issue bonds itself. Okay, then on the other end of the spectrum is your risky high yield bonds there. These are issued by companies which are deemed to have a high risk of defaulting. But in return for bearing that higher risk, right, they do give you better yields, right, than investment grade and government issue bonds. Why invest into bonds? Well, the first reason is that bonds hold a much lower risk, right, than risky assets such as stocks. So this is going to appeal to people who does not want to put all their money into risky assets itself, right? And do not mind at the same time having a lower level of return. Okay. Now, second, bondholders actually have a greater priority when it comes to claims of payment because debts are contractual obligations. So bondholders have to be paid first, right, before stockholders. So when you hold a corporate bond and then the company, let's say, went into bankruptcy, right, bondholders actually have a higher chance of getting something back, right, than stockholders itself. And lastly, right, bonds can provide good diversification benefits in times of crises and recessions. Not always, but that is usually the case, right? Because during such times, many people will start to sell off or unload the risky assets, and then they will park their money, right, into safe haven assets such as government bonds. So you can see from this chart here, right, during each of these major stock crises or corrections, your treasuries actually increase in value instead. So that can provide you a good buffering effect, right, against risky assets such as stocks. So including bonds as part of a diversified portfolio is often seen to have great diversification benefits. What are the risks of investing into bonds? Now, the first risk is what we call the default risk. Okay, and it is also the most obvious risk, right? Because when you hold on to the bonds of a company, these companies can run into trouble, right, for various reasons. And then they can technically or theoretically default on their bond payments. Now, government bonds, right, or US government bonds are considered virtually free of default risk. Okay, but that, however, doesn't mean that all government bonds are the same. So government bonds from other countries, in particular, let's say countries of emerging markets, right, can also default. All right. Now, aside from default risk, bonds have two big enemies. And the first is inflation. The second is interest rates. So, and these two are often tied together, right? Because a high level of inflation will also result, right, in central banks pushing up the interest rates itself. Okay. Now, with higher inflation, bond prices will fall. And why is that the case? Right, because the future payments, such as your coupons that you're going to receive with most bonds, are already fixed. So there are no means, right, for the bonds to actually go and adjust for changes in inflation, right? That's why they're also called fixed income. All right. So your future cash flows and bond are actually now worth less, right, if inflation goes up. And that erodes the value of your bonds. Okay. And bond prices also have, right, an inverse relationship with interest rates. So if interest rates goes up, bond prices comes down, and vice versa. So this relationship is quite intuitive actually, because if you look at it, if interest rates goes up, the bonds you hold whose payments or coupons are based on the old and lower rates, they'll become less attractive. So in return, you got to sell them at a discount, else there's not going to be anyone, right, who's going to buy it. Right? Because buyers can now go into the market and purchase, right, the new bonds, which will be paying them a better coupon rate, right? Now, to see, right, how high inflation and rising interest rates can affect bonds this year, right, 2022 is actually a very good example. So if you look at the chart here, right, all the bonds are falling, right, whether it is government bond, whether it's corporate bonds, and within corporate bonds, whether it is your investment grade bonds or your high yield bonds. Last question, how to invest in bonds? Now, to buy or sell bonds, right, again, what you need is just a broker to provide you access to the bond markets. But unlike stocks, bonds are what we call over-the-counter or OTC products, so they're not actually traded on exchanges itself, all right? And for US Treasuries, they do hold regular auctions throughout the year. And if you want to participate in those auctions, you can open an account with the platform Treasury Direct to do so. Or alternatively, you can actually gain exposure by investing into like futures, mutual funds, or ETFs. And we have Treasury futures. Okay, there are also many mutual funds and ETFs that invest into a diversified portfolio of bonds across like different maturities. So you have actually plenty of choices, all right? Okay, so there it is. You can start trading. Okay, so this is all I have today for this video. It is a basic introduction to bonds, and if you're new to it, I hope you have gained something and learned something of value today. And if you think what we're doing is useful, do let us know by clicking on the like button below and subscribe to our channel for more updates. Okay, and feel free to share this video with your friends or anyone else who you think might benefit from it. Like that will be very much appreciated here. Alright, and for information at AllQuant, we also conduct a range of courses on investing. So if you're interested, you can visit our website for more information. Okay, the link to the website is in the YouTube description below. Okay, so at the end of it, I wish you all the best year in your investing, and I will see you in the next video.